In every stable financial plan, one principle stands above mere accumulation: the power of giving. True wealth isn't measured only by assets, savings, or investment returns. It's also reflected in how responsibly wealth is circulated for good causes. In the United States, philanthropy has been a foundational part of responsible finance for generations. But in today's complex economy, giving must move beyond emotional generosity and become a structured, strategic part of a person's overall financial framework. When we talk about philanthropy, many imagine grand gestures, billionaires pledging fortunes, or public donations displayed in headlines. But the essence of giving lies in discipline and purpose. Every individual, regardless of income, can build a system for contribution that aligns with ethical values and long-term financial stability. It's not just about donating. It is about integrating generosity into one's plan in a way that sustains both personal finances and community welfare. The first step in this framework is defining intent. Why do you give? Is it gratitude, social responsibility, faith-based duty, or community improvement? This question anchors every decision that follows. When intention is clear, philanthropy becomes sustainable, not sporadic. Many Americans start by allocating a specific portion of their monthly or annual income for charitable purposes. This approach transforms giving from a random act into a consistent financial habit. The key is proportion, not size. Even a modest, predictable contribution has greater long-term impact than occasional, impulsive donations. Once intent is defined, structure must follow. Think of philanthropy like investment, requiring planning, allocation, and tracking. Begin by creating a separate fund or account solely dedicated to giving. This psychological separation prevents emotional overspending and encourages accountability. Some individuals automate a fixed percentage of income, such as 2% to 10%, into their giving account every month. The number isn't as important as the discipline behind it. Over time, this account becomes a reflection of consistent generosity, not leftover charity. Next comes alignment. A strategic donor aligns their giving goals with their broader financial plan. This means considering giving alongside retirement planning, emergency savings, insurance, and investment portfolios. When generosity is treated as an equal pillar of financial planning, it stops being viewed as a sacrifice and starts being recognized as a valuable asset. For example, a person saving for retirement might simultaneously fund educational scholarships or community health programs through recurring, sustainable contributions. The outcome benefits both personal peace of mind and societal improvement. Many people assume that generosity conflicts with financial security, but in reality, the opposite is true. Studies from behavioral economics show that individuals who practice structured giving experience higher levels of satisfaction and financial awareness. Giving refines budgeting habits, curbs material excess, and strengthens decision-making. By planning to give, you learn to plan better in every financial area. This principle creates a harmony between personal stability and public contribution, a balance that defines ethical prosperity. The next element in this framework involves values and impact measurement. Not every donation is effective simply because it's made. Strategic philanthropy requires due diligence. Donors should research the causes they support, ensuring transparency, accountability, and real outcomes. This means reviewing annual reports, financial statements, or third-party ratings of organizations. By doing so, generosity transforms from emotion to education. Every dollar becomes a deliberate investment in measurable change. In the USA, tax systems also recognize the social importance of structured giving. Donations to qualified non-profit organizations can reduce taxable income, which encourages citizens to participate in philanthropy responsibly. However, this shouldn't be viewed merely as a tax-saving tactic. Instead, it represents an acknowledgement from society that ethical financial behavior benefits everyone. Responsible donors use these advantages wisely, reinvesting saved amounts into future giving cycles, multiplying impact without straining personal budgets. A sustainable giving framework also requires awareness of timing. Not every financial phase allows for equal generosity. Young earners might focus on building stability first, contributing smaller but consistent amounts. As income grows, contributions can expand. During retirement, some individuals establish foundations or donor-advised funds to continue their legacy of giving. This life cycle approach ensures that philanthropy evolves with financial capacity. It's not static. It grows with wisdom and opportunity. An often overlooked dimension of giving is community. Involvement beyond money, time, skills, and mentorship are forms of philanthropy with equal moral and social value. Volunteering in educational, environmental, or youth development programs amplifies the spirit of generosity. When combined with financial donations, this creates a powerful hybrid of action and contribution. Financial giving sustains programs, while personal involvement strengthens community bonds. Together, they form a complete cycle of ethical wealth use. Integrating giving into a financial plan also demands emotional balance. The intention behind philanthropy should be genuine service, not social validation or guilt. The best givers operate quietly, guided by conviction rather than recognition. This mindset not only ensures purity of purpose, but also preserves humility, a core element of moral finance. When giving becomes habitual, it naturally shapes one's worldview, reducing attachment to excessive accumulation and encouraging gratitude for what one already has. Modern tools have made giving more efficient and traceable. Digital platforms, automated transfers, and transparency-focused charities allow people to manage donations with the same precision as investments. But technology should be used responsibly. True philanthropy requires human connection, understanding, and follow-up. Watching our contributions create change keeps generosity grounded in reality, not lost in screens or numbers. Every structured financial plan requires review, and giving is no exception. At least once a year, individuals should evaluate how effectively their philanthropic efforts align with their goals and ethics. Has the giving been consistent? Has it reached the intended beneficiaries? Are there new causes that deserve attention? This reflection ensures that generosity remains dynamic and relevant. Ultimately, a financial plan that includes philanthropy is a plan built for purpose. It transforms wealth from a personal tool into a social asset. It converts financial independence into community interdependence. When giving is structured, intentional, and ethical, it creates a continuous cycle of blessing for the giver and for society. Money gains meaning only when it serves a higher purpose. By establishing a framework for giving, individuals create balance, not just in ledgers, but in life. They secure not only their future, but also contribute to the well-being of others. That is the essence of responsible wealth. When generosity becomes a structured element of financial planning, the next question arises: how can giving be made sustainable, scalable, and ethically impactful across a lifetime? The answer lies in designing a comprehensive framework that balances faith, finance, and foresight. Every dollar has potential, and every act of giving can be multiplied when guided by a disciplined approach. True philanthropy is not spontaneous emotion, but a consistent strategy built on wisdom and awareness. At the foundation of this philosophy is the concept of stewardship. Wealth is not owned in absolute terms, it is held in trust. This mindset changes everything. When individuals see themselves as caretakers rather than sole owners, financial decisions shift from self-centered accumulation to purposeful management. In American financial culture, this is reflected through charitable trusts, community foundations, and planned giving programs. These structures enable individuals to extend their generosity beyond their lifetime, transforming financial success into ongoing community benefit. A sustainable giving strategy begins with long-term clarity. Every giver should define what legacy they want their contributions to leave. Some aim to improve education, others focus on healthcare, environment, or poverty reduction. This clarity converts generosity from an occasional donation into a mission-driven plan. A well-defined philanthropic vision also simplifies decision-making during uncertain times. When markets fluctuate or income levels change, having a clear giving mission prevents emotional reactions and maintains focus on purpose over pressure. The next essential element is integration. Philanthropy should not stand apart from one's personal finance plan. It should live within it. For example, if an individual follows a standard budgeting framework that includes expenses, savings, and investments, philanthropy must be included as a consistent line item. By assigning a fixed percentage, the act of giving gains the same level of importance as saving for the future. Over time, this transforms generosity from an afterthought into a disciplined lifestyle habit. Financial advisors often suggest using diversified vehicles for giving. These include donor-advised funds, community investment programs, charitable remainder trusts, or direct contributions to verified organizations. The purpose of using these structures is not to complicate giving, but to ensure longevity and accountability. Donor-advised funds, for instance, allow individuals to contribute today, receive potential tax benefits, and distribute funds gradually over years. This approach ensures that giving remains consistent even when personal cash flow varies. It also allows for planned, deliberate impact instead of emotional reactions to every appeal. However, structure alone does not guarantee moral alignment. Every philanthropic decision must be guided by values. For example, donations should never be directed toward causes that contradict ethical or faith-based principles. A halal financial mindset prioritizes transparency, fairness, and social benefit, supporting programs that promote exploitation, unethical lending, or harmful industries would conflict with these values. Therefore, due diligence must always precede giving, reviewing mission statements, operations, and financial reports of organizations before contributing. Modern American society offers countless giving opportunities, from online crowdfunding to international aid networks, yet not all platforms are equal in integrity or efficiency. Responsible givers focus on traceable results. They evaluate the ratio of administrative costs to direct aid, ensuring that the majority of funds reach intended beneficiaries. Ethical giving is not about emotion, but about measurable impact. The satisfaction of giving should come not from spending, but from seeing real change. A growing trend in the USA is the concept of social return on investment, or SROI. This idea extends the financial term return on investment into the moral domain. It measures how effectively donations create positive outcomes in society. For instance, an education-focused charity might demonstrate that every $100 donated results in a year of schooling for a child. This data-driven approach allows donors to make informed decisions and inspires confidence that generosity is producing tangible progress. To maintain balance between personal needs and public benefit, the giver must establish financial boundaries. Overgiving, donating beyond one's means, may lead to instability and regret. True philanthropy operates within wisdom and moderation. The most effective givers are those who sustain both their own well-being and the well-being of others. This balance allows generosity to continue for decades, rather than ending after a few impulsive moments. It also ensures that giving remains free of guilt, compulsion, or emotional burnout. Another important factor in the framework is timing. The life cycle of giving can be divided into three broad phases: the earning years, the growth years, and the legacy years. During the earning years, contributions may be small but consistent, developing discipline. In the growth years, as assets expand, generosity can scale to include scholarships, microgrants, or community initiatives. Finally, in the legacy phase, structured plans like endowments or foundations can extend impact beyond one's lifetime. This evolution ensures that philanthropy remains dynamic, adjusting naturally with personal circumstances. Education plays a crucial role in strengthening the culture of giving. When children are taught the value of generosity early, they learn that wealth carries responsibility. Many American families include their children in charitable decisions, allowing them to select causes, research organizations, or volunteer. This practice not only builds empathy, but also creates a generational chain of ethical financial behavior. Philanthropy becomes a family value, not a personal act. The digital era has transformed how people participate in giving. Online platforms allow instant contributions, real-time updates, and global reach. Yet, while convenience has increased, the risk of superficial giving has also risen. Clicking a donate button is easy, but understanding the deeper impact requires intention. Ethical donors balance technology with awareness. They track results, follow up with organizations, and stay informed about outcomes. This mindset turns passive giving into active partnership, where the donor becomes part of the solution, not just a financier. Transparency remains one of the pillars of sustainable philanthropy. Informed donors request clarity on how their contributions are utilized. In the USA, many organizations now publish detailed annual impact reports outlining how each dollar supports their mission. This transparency strengthens trust and encourages more people to give. It also aligns perfectly with the principle of financial integrity, ensuring that every contribution reflects honesty and accountability. One often overlooked dimension of giving is the emotional and psychological reward it brings. When generosity is consistent and purposeful, it nurtures inner peace. People who give regularly report higher satisfaction and reduced financial anxiety. This is because giving reframes one's relationship with money. It transforms money from a source of stress into a means of service. In an economy driven by competition and consumerism, Philanthropy restores balance by reminding individuals that wealth's highest function is contribution, not consumption. Ethical giving also has macroeconomic significance. Philanthropy fuels non-profit organizations that fill critical social gaps, from education to healthcare, housing to environmental care. These organizations create jobs, stimulate local economies, and reduce government burden. When philanthropy is organized and transparent, it becomes a parallel system of social development, complementing public policy. Thus, each responsible donor indirectly contributes to national progress. Sustainable giving also benefits businesses. Many American companies integrate philanthropy into corporate finance. Through social responsibility programs, they allocate a percentage of profits to community initiatives, education grants, or employee volunteering. This not only strengthens public trust, but also improves internal culture. Employees working for companies that care about community well-being often demonstrate higher loyalty, motivation, and productivity. In this way, generosity becomes a business asset, not just a moral gesture. As financial literacy grows, individuals are realizing that giving does not reduce wealth, it refines it. The act of allocating a portion of earnings for good causes creates discipline, gratitude, and long-term clarity. It helps control impulsive spending and aligns financial behavior with moral values. The person who gives thoughtfully understands both the power and responsibility of wealth. Such individuals are less vulnerable to greed, debt-driven habits, and financial anxiety because they view money as a means, not a master. An advanced step in philanthropy is impact investing. This approach allows investors to support businesses or projects that generate both financial return and social good. Examples include renewable energy ventures, ethical housing projects, and educational technology startups. While this model must be evaluated carefully to ensure halal compliance, it represents a bridge between traditional finance and moral impact. The key principle remains the same: wealth should serve a purpose beyond personal benefit. Another dimension of a giving framework is collaboration. Collective philanthropy magnifies results. When individuals, families, or communities pool resources toward a shared goal, the impact becomes exponential. Community endowments, regional trusts, and group donation programs demonstrate how small contributions can build significant, lasting change. This cooperative model also reflects the social principle that strength grows when people unite under a shared vision. Regular evaluation ensures that the philanthropic framework remains relevant and effective each year. Givers can assess their approach by asking practical questions. Has my giving remained consistent with my values? Have I diversified my causes effectively? Are there better ways to achieve measurable impact? This reflection keeps philanthropy dynamic rather than routine. Like any financial strategy, giving must evolve as society and technology change. At the spiritual and psychological level, generosity nurtures humility. When people contribute to causes larger than themselves, they acknowledge their interconnectedness with humanity. This realization guards against arrogance and cultivates gratitude. Wealth becomes a bridge, connecting privilege with need, ability with opportunity. This mindset not only improves individual character, but also strengthens the moral fabric of society. In a complete financial framework, giving is not the final step. It is the recurring pulse that keeps wealth alive. Just as savings ensure future security and investments drive growth, philanthropy ensures moral continuity. Together, they form the triangle of responsible finance, earning ethically, spending wisely, and giving purposefully. When these three elements align, prosperity becomes sustainable and honorable. Every financial decision leaves a footprint. Some fade with time, while others shape generations. A framework for giving ensures that one's financial legacy carries forward with integrity and compassion. It transforms temporary success into timeless significance. Money, when used responsibly, becomes a language of care, a silent force that uplifts communities, restores dignity, and inspires others to give. A person who plans their giving as carefully as they plan their savings masters the art of balanced prosperity. They understand that generosity does not weaken a financial plan, it strengthens it. In the long run, it creates a deeper sense of fulfillment, stability, and faith in the flow of provision. This is the essence of ethical wealth: to earn with honesty, manage with wisdom, and give with purpose.